Investing in real estate is a tried and true way to grow wealth. The wealthy all have multiple real estate investments in the form of houses, buildings, and land, to name a few. If they can do it, why can't you? Oh, that's right, you don't have the money to invest in real estate. Don't worry though, you have options through REITs. Let's explore what these are, how they work, and most importantly, how to invest in real estate with little capital. Understanding real estate investing. Why do the rich have so much invested in real estate? Aside from the potential fortune that could be amassed from proper investing, there are reasons why this is such a ubiquitous way of making money. Before we get into REITs, let's first understand the pros of real estate investing, and then let's get into the cons. Real estate investing pros. Real estate tycoons love to invest in property and favor these types of investments over others. Let's go over the main reasons why they love real estate. Earning potential is huge. Generally speaking, real estate properties have increased in value year over year since the beginning of time. Whether the investment is in a home, apartment building, or parking lot, if the location of the property resides in a popular area, you'll likely generate a positive return in a future flip. If the area still has a lot of growth in progress, the earning potential is almost guaranteed. Makes sense why the number one rule in real estate investing is location, 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 doesn't it? Steady source of income. Real estate investing usually takes time to make a profit. Mortgages take a while to pay back, so it could end up taking decades before you ever see a return. It's possible to receive a steady flow of income through rental properties while paying off your loans. The real benefit here is that once you're finished paying back the bank, your tenants will continue to pay you monthly rent, all of which are profits. This is why many investors choose to keep the property as a steady source of income rather than flipping it. Tax benefits with rental property. Aside from the potential of being a cash cow, rental properties can also save on taxes. The areas where you'll see the most tax deductions are mortgage interest, depreciation, property taxes, repairs, and other expenses. So if you have to repair the roof, sprinkler system, flooring, or water heater, all tax deductible. What about paying for rental advertisements, insurance, utilities, and travel expenses? Yep, they're all tax deductible too. Protection against inflation. Increases in inflation rates harm your portfolio of investments. These days, with the government printing money, inflation looks like it isn't letting up anytime soon. Luckily, real estate investments generally keep pace with inflation. This means that if a gallon of milk goes up in price, your rental properties go up in value. You can charge more for rent as a result of this. The beauty here is that, although the annual rent increases, ownership cost stays the same. Inflation will drive the general cost of living higher while simultaneously increasing your cash flow. Inflation is usually a good thing for property owners, especially since in the future, the property's value will be worth a lot more than it is now. Real estate investing cons. It sounds like real estate investing is a solid choice with plenty of benefits. However, there are some disadvantages as well. Let's explore what they are. Large upfront capital. Although there are financing options to invest in real estate, you'll still need a relatively large amount of cash for a down payment, closing costs, and initial repairs. Don't forget that you'll need to pay for maintenance, insurance, property taxes, and the mortgage as well. The costs involved with real estate usually deter amateur investors from starting in the first place, and it isn't surprising to see why. Steep learning curve. If you don't know what you're doing, then it's going to be a long uphill battle before you make that first return. Each type of real estate requires research, which will take a while to learn unless you have a mentor. Additionally, once you do purchase a property, the active management will not only take up your time, you'll need to learn that too. The best bet to accelerate your learning is to find someone who's already been in the real estate game for a while. You'll need to find a mentor that is willing to help you, and this is, of course, something you'll need to learn how to do. Expect challenges. Prepare yourself for headaches when personally managing your real estate. Whether it comes in the form of additional costs or losing money through vacancies, there is no shortage of complications that will arise. Ever complain to your landlord about your roof leaking or the loud music from the unit above you? You as the landlord will need to deal with that. What about when a bad storm damages windows or the siding? You'll need to have that fixed while you address your tenants' complaints, not to mention the liabilities that come with accidents. Vacancies can especially be demoralizing when considering you're essentially losing money for every month that your unit is unoccupied. Understanding REITs. Now that you have an understanding of what's involved with real estate investing, we can now get into REITs. A real estate investment trust, or REIT, is a company that owns and manages various properties that produce income. Similar to that of mutual funds, investor funds are pooled together so that individual investors can buy shares in commercial real estate portfolios. This means that you can invest in real estate without having to own, finance, or operate the property directly. How it works. Back in 1960, Congress introduced REITs to the average investor, providing them a way to invest in large-scale income-producing real estate. These may include shopping malls, hotels, apartments, office buildings, self-storage facilities, loans, and mortgages, to name a few. REITs purchase properties so that they can develop them into money-generating assets. REITs enjoy the benefit of not being required to pay taxes at the corporate level. This makes it cheaper for them to finance property, which ultimately translates to bigger and more frequent dividend payouts. They do have to follow a certain set of rules mandated by the IRS, though. A minimum of 75% of the total assets need to be in real estate, U.S. Treasuries, or cash. A minimum of 75% of the gross income needs to come from real estate sales, interest on mortgages, or rents. A minimum of 90% of taxable income needs to be paid out to shareholders as a form of yearly dividends. The REIT must be taxable as a corporation. The REIT must have a board of directors that manage the direction of the trust. A minimum of 100 shareholders must be invested in the trust within the first year. A maximum of 50% of its shares being held by 5 investors or less. Key benefits of REITs. All of these requirements imposed on REITs create benefits for the investor. The low barrier of entry is the main draw with this type of real estate investment. REITs can often be seen for less than $10 a share, so you can count on building a diverse portfolio without breaking the bank. You stand to get high-yielding dividend payouts while not having to pay corporate tax as an individual investor. Since publicly traded REITs are bought and sold on the stock market, liquidity isn't an issue. It's much easier and quicker to sell an REIT in the market than waiting to profit from physical real estate property. Be aware of its limitations. Although REITs can be profitable investments, understand that there is still some risk involved. When taxes are concerned, REITs will often have great dividends and are not at the corporate level. However, since the IRS doesn't classify REITs as qualified dividends, this means you'll be paying more in taxes as compared with qualified dividends, which are taxed at long-term capital gain rates. Keep this in mind when you're setting up your REIT portfolio. If you're invested in a non-traded or private REIT, liquidity can be a problem. One of the main reasons for this is because it can't be valued as easily as publicly traded REITs. If you buy into any of these, expect to hang on to that investment for years before you get the chance to sell. REITs provide tons of benefits for the investor, but be aware that they typically grow at a snail's pace. Because so much of the profits are paid out to shareholders, they need to issue new stock shares and bonds to grow. The issue arises when there may not be an interest from investors to buy these. As opposed to real estate investing, REITs don't have the luxury of buying property at their leisure. Should I invest in REITs? REITs are perfect for those who want to get into real estate investing but don't have the upfront capital to purchase properties by themselves. It's easy to get started, and you can start investing today. There are plenty of brokerage accounts that you can choose from, all with different rates, fees, and costs. Make sure to shop around to find one that best fits your needs. Whether you invest in real estate the traditional way or take the less risky route with REITs, just know there are risks present in both. Work through the pros and cons of each and invest only what you can afford to lose. I hope you guys enjoyed this video. Please give it a thumbs up and subscribe to our channel, and let's help us grow. Thanks for watching. I'm out now, so stay smart and think long term.